Greetings from 3Edge Asset Management, and welcome to the View from the Edge for December 2020. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge.
And I'm Eric Biegeleisen, Director of Investment Research.
As we do each month, Eric and I will discuss our firm's most recent outlook for the global capital markets based on our proprietary research model. We have a lot to go over today, so let's get started. Now we have reached a point where there's less than a month to go before we turn the page on 2020, a year that in many ways has been extremely strange and difficult, as we've all had to deal with the onset of a global pandemic and a presidential election which served to amplify the partisan divide in our country. But before we look ahead and talk about our outlook, we should at least mention what happened last month in the equity markets in November. Last month, equity markets across the globe experienced a kind of investment performance which would be considered a good year in the course of just 1 month. In the US, the S&P, the Dow, and the NASDAQ all rose by over 10% in November. The Dow rose above the 30,000 mark for the first time ever. And in addition, ex-US equities also experienced similar strong performance in November. Last month's rally was fueled by the conclusion of the US presidential election and continuing positive news about the development of numerous potential coronavirus vaccines. Equity markets also continue to be on the receiving end of a large amount of central bank liquidity that's not being absorbed by the real economy, but rather it's finding its way into the equity markets. It appears as though this central bank liquidity should continue well into 2021. So with equity markets hovering around all-time highs, it isn't obvious where we go from here. So I'm pleased to be joined here today by Eric Biegeleisen, Director of Investment Research here at 3Edge, to sort things out for us. So Eric, let's discuss the 8 major asset classes that represent the highest level view of our investment universe. And why don't we begin by taking a look at the 4 equity asset classes that we model, beginning with US equities.
Great. Thanks, Fritz. That's a great overview. So overall, I'd say not a tremendous amount of change in the outlook across the asset classes, though another month like we just saw in November could have the potential for significant behavioral headwinds towards many asset classes. That being said, there are still some changes worth noting. So starting with US equities remain overvalued. We've been saying this for a number of months, on par with just prior to the tech stock bubble in 2000 and just prior to the crash in 1929. But what's interesting this month now is that as we measure valuation, we find US equities to be the most overvalued that they've ever been since we start our modeling back in 1871. Now, that being said, we've also noted overvalued markets can get even more overvalued. So we're not suggesting there's some imminent correction, but we should be aware of this level of valuation and be ready to move should things turn. So all that said, the benefits you mentioned, though, from the Federal Reserve's monetary stimulus balance sheet expansion, that has served U.S. equities well and will continue to serve markets well for some time as those decaying effects from all of that stimulus take time to fully roll off. And we've seen positive investor momentum, which is likely fueled from the efficacious vaccine developments that you noted. So on net, the research does favor U.S. equities, though with a healthy dose of caution just due to this overvalued nature.
Very good. So I did notice that this month, both Japanese and emerging market equities are ranked more favorably than U.S. equities by our model. So what are we seeing there in terms of Japan and emerging market equities?
Yeah, at first blush, it might seem like an odd pairing to talk about the two together, but they are both maintaining their positive outlooks in our research for similar reasons. They're both exhibiting steepening yield curve measures in the way that we calculate it, which is indicative of the future prospects for growth. Along with both are showing positive investor psychology. Both are relatively more attractive on a pure valuation basis, certainly with respect to the United States. And finally, both regions have generally fared better than the US or Europe with regards to limiting the spread of new coronavirus cases.
Excellent. And now even our model is even somewhat more favorable towards German and European equities this month. What are we seeing there that might be different?
Yeah, the outlook for European equities has been oscillating over the past several months between being either somewhat negative or somewhat more mixed or neutral for some time. And as you noted, this month it's shifted upward to this more neutral type of or mixed outlook. The yield curve measure that we calculate there is inverted and has been for some time, which is indicative of more of a contraction rather than a growth type of environment in the region. Many European countries have also seen this strong resurgence of COVID-19 cases, like in the United States. Though there is this offsetting force at play we're seeing, which is stemming from positive investor psychology as we measure it. And that's likely from the planned and publicized central bank stimulus measures that may be coming. So, European equities did enjoy an even stronger November than asset classes that we model. But if you look longer term, say on a year-to-date basis, it still has some catching up to do. So more to come in this region.
Right. Very good. Great. So now let's switch from stocks to bonds and look at what our model research is telling us about both the outlook for interest rates and the credit markets.
Yeah, we've noted for some time that the Fed stimulus measures taken earlier this year have really influenced the Treasury market. It's pushed the entire maturity Treasury yield, pushing every maturity of the Treasury yield curve below the expected rate of inflation for that same duration, meaning that there's negative real rates on the entire Treasury yield curve. So it's difficult to have an optimistic outlook on Treasuries in this type of environment. With regard to credit, we've seen a notable tightening in credit spreads, particularly in the high yield market. And in theory, that'd be a positive for the space. But as we've noted, the risks of an unwind would likely happen swiftly and could cause a lot of damage. And therefore, our research, it doesn't really approve of that risk return trade-off yet.
Right. It is quite incredible how much credit spreads widened out during the February-March correction, and then conversely, how much they've now narrowed. It's been kind of a wild ride.
Definitely.
So great. So let's switch now to real assets and commodities. Gold had a tough November, declining, but it still has been up quite strongly on a year-to-date basis. Why don't we start with gold, and what are we seeing there?
Yeah, you're dead on the year. Gold is one of, if not the best performer in terms of the asset classes that we model. Though, as you noted, November was one of the only negative performers actually in the month. So nonetheless, our research does continue to favor gold, and one of the largest and most important reasons for that is the negative real yields that we just talked about with regard to the fixed income outlook. The current real yield on a 10-year note is negative 93 basis points, or said differently, negative 0.93%. So why hold a paper asset like a bond, locking in a negative real return, when you can hold a store of value like gold, priced in US dollars, that should benefit from increasingly negative real rates?
Excellent. And then what about commodities? What are we seeing there?
Yeah, this is another area that we've seen a somewhat improved outlook as compared to, say, last month. We have a few indicators there, including the tightening of credit spreads we just talked about, the continued emerging market recovery, stronger emerging market currencies, positive investor momentum about the prospects of recovery really taking root in various regions around the world, due to vaccine distribution may be underway shortly. So all of these things are helping the commodities outlook.
Excellent. And so last would be cash, which I believe now is actually ranked lowest in December from the model research. I suppose that could be more of a function of the relative opportunities elsewhere. Is that the case?
Yeah, I think that's a great way to look at it. We do refer to it as dry powder, and it's great to have there when other asset classes have too much risk, perceived risk at least. And at this time, we find opportunities in Japanese and emerging market equities alongside gold and commodities. So much of that cash has been deployed to be put to work in these spaces.
Excellent. All right, great. So thanks, Eric, for getting us caught up in terms of our research model. And now, as we do each month, I'm going to ask Eric for his 3 most important takeaways from today. So Eric, what do you have for us this month?
Sure, yeah. Number 1, Japanese and emerging market equities. They continue to be the most favored by our research. U.S. equities are positive as well, although highly overvalued. And European equities are a bit more mixed. Number 2, despite gold's November pullback, gold and commodities are also favored by our research. And 3, we want to mention here, not all is rosy. Right? Risks remain to our outlook, and we'll be watching these and other items to see how it may change our outlook over time. These types of risks include the potential for a U.S. government shutdown this month, Funding expires by the government on December 11th, and negotiations are currently underway. We'll be watching that. 2, you have the Georgia Senate runoff election in January. That could markedly change the political landscape in this country, depending on the outcome of that. 3, there's nascent global geopolitical tensions bubbling up in various unrelated places around the globe, including the assassination that just took place in Iran, growing China-Taiwan tensions, and as always, North Korea. And 4, there's, of course, a worsening resurgence of coronavirus cases with record hospitalizations and deaths. And this could force more draconian economic restrictions across the country, which would be damaging to growth.
It's tempting for investors to forget about all those risks when you see a market run up the way it did in November. So thank you for that last piece. So great. So that is a wrap. Thank you, Eric, for providing us with your valuable insights into our 3-edge model research.
Yes, thanks, Fritz. Always my pleasure to be here with you. Great.
Eric and I will be back once again in early January of 2021 with the next edition of the 3-edge View. As a reminder of our 3-edge YouTube channel, please feel free to subscribe to our YouTube channel. That means is that you'll receive notification as we release our videos over time. Also, feel free to share these videos with anyone who you think might be interested. And with that, from everyone here at 3-edge, stay safe, stay strong, particularly as we face what may be a tough couple of months in terms of the coronavirus. Keep the faith, and thanks for listening.